Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Welcome back, everyone, to the CreditSights No More, Risk Better podcast. My name is Logan Miller. I am the head of European strategy based out of London, and today I'm pleased to be joined by my colleague, Jim Williamson, who is the head of European autos here at Research. And today we're going to go around and really just do a deep dive into the European autos sector, specifically focused on the OEMs. Clearly, they've been front and center when it comes to some of these global growth gyrations, as well as obviously the sort of near and dear and directly impacted by U.S. tariff situation, trade wars. So definitely, probably I would say the most topical sector still within the European credit markets at this point. We're coming off of the second quarter earnings results for the sector, so it's going to be great to get Jim's insights today. So Jim, welcome back to the podcast. It's been almost a year since we last did this, but lots definitely changed since that period.
Yeah, thanks for having me. I think last time we were here, we were relatively negative on the sector, and 12 months on, and we're maybe coming at it from a slightly different angle. So it'll be good to unpack some of the themes that have happened, and see if we can add some value for clients.
Like I mentioned, autos have clearly been kind of front and center this year from a credit risk standpoint, particularly as it relates to the shakeup to the status quo for global trade. I recall last year around this time, you were pretty cautious on the space, and in fact, for most of 2024. But it seems that you've gotten increasingly more constructive on the sector despite tariff headwinds. So, that seems like a very kind of quite non-consensus view to me. Do I have that right? And can you sort of walk me through your current rationale for the sector?
Yeah, sure. So yeah, as you point out, this time last year, we were kind of very cautious on the sector heading into the second half of 2024. And I think a lot of that was fundamentally driven. There was a lot of weakness around China. There were things like rising dealer inventories. Consumer was becoming a lot more cautious. But just generally speaking, spreads were very tight in the auto sector as well. So we had the IG Autos Index trading pretty much in line with the IG index. That kind of proved to be the right call. We had a pretty aggressive repricing of spreads through the second half of last year. Pretty much every company that we cover ended up cutting their guidance in one way or another. We saw a pretty quick and severe widening of spreads. So we came into this year actually with the view that we'd seen the sector de-risked quite a lot because of that widening of spreads. But we had this looming headwinds from the tariff risk where, despite spreads being quite cheap when we screened them, it didn't necessarily make sense from a risk-adjusted standpoint to be overweight. So coming more recently, we've kind of finally pulled the trigger on becoming more constructive. Obviously, still a lot of tariff-related headlines that are coming through, but I think that now, where we are now relative to even a few months ago, we do have a lot more certainty around what the outlook looks like. And that's kind of helped us in our conviction moving to a more overweight position on the sector.
That's a theme that has definitely been driving markets over the last several months or so. Obviously, we had the EU-US trade deal or framework that was announced less than a month ago. But I think if you had told the market that 15% baseline tariffs was going to be the reality earlier this year, we probably would have seen a pretty major repricing of spreads and just risk assets in general. But that certainly has not been the case. And at least now we have some sort of the potential for tariffs to be sort of in place and what's going to look like, what the rate's going to look like. I think that's definitely providing somewhat of a kind of relief to investors, just given how much just the degree of uncertainty there was pre sort of deal. But let's stick with the tariff topic, Jim. Can you kind of walk us through your takeaways from the latest trade agreement between the EU and the US?
Yeah, so I think there's two different angles that we can come at the tariff situation now. The first is that objectively tariffs are bad for the auto sector, and they're going to have a pretty financially meaningful impact on these companies. Margins are now coming down into the kind of mid-single digit area for most of the companies under our coverage. And that's a long way from the, 10, 11, 12% margins that we had back in 2022, 2023. So when we look at the guidance for this year, a lot of companies now are incorporating the tariff impacts, and we're looking at 5 to 7%, say at BMW, 4 to 6% operating margins at Mercedes, 4 to 5% at VW. So, without question, I don't think we can just glance over the fact that this has had a material impact on these companies, both directly in terms of having to stomach the additional costs of importing vehicles into the US, and then some of the more indirect costs around how consumers may be being a little bit more cautious right now, given some of the uncertainty. But on the other side, I would say that, when we think about where we are now relative to March or April, we have kind of cut the left-hand tail off the distribution in terms of some of the, more severe or punitive outcomes that we could have had. It wasn't long ago where 30% tariffs were looking like a very strong possibility in Europe. There was reciprocal tariffs being lined up on both sides of the Atlantic. You only need to look at what's happening in China with, the threats of 100+% tariffs to see what the potential, how far the Trump administration is willing to go if deals are not negotiated. I think when you look at where we are now relative to April, March, at least we have quantifiable impacts where we can actually look at it and say, the margin impact's going to be 100, 200, 300 basis points, whatever it is. And there's some certainty for these companies now to look ahead and say, how are we going to change our footprint in terms of manufacturing? How are we going to adjust our pricing? Where can we cut costs and things like that? I think from that perspective, the sector potentially is coming out a little bit better than what the worst case scenarios were, but certainly not unscathed.
I think what companies are saying about tariffs, are they doing anything or thinking about doing anything in order to circumvent the full impact these new kind of tariff levies will have on margins?
Yeah, so I think it depends on, for each company, it depends on your footprint, where you sell vehicles, things like that, as to how impacted you are. But what we're kind of seeing now is that somewhere in the 100 to 200 basis point area is becoming kind of a kind of consensus, I would say. If you have maybe a stronger manufacturing footprint in the US, maybe it's closer to 100. And if you're doing a little bit more exporting or importing into the US, maybe closer to 200. So that's for 2025. Now we're starting to see some of the mitigation that they're trying to implement. So the obvious first starting point is where you produce. So like your localization strategy. Volvo, for example, has decided they're going to localize their best-selling model in the US. So that's going to help. BMW, Mercedes even is looking at manufacturing some vehicles in the US. But that's more of a multi-year thing where, if you start now, you can probably have that up and running maybe 2027. So that's going to help longer term. More near term, I think cost cutting is a big one where it's not necessarily related to tariffs, but it's being driven as a result of now these companies are going out and trying to find additional ways to cut costs. We saw Volkswagen, for example, 18 months ago, getting some concessions from labor unions around cutting about 35,000 jobs in Germany, reducing their capacity by 750,000. Mercedes reducing their capacity by 100,000 units in Germany, another 200,000 in China. So you do have that. Cost cutting can be a bit of a blunt instrument in the auto sector, but it certainly helps to mitigate the impacts of this kind of 100, 200 basis points. And it's something that in many cases they've already been doing for the last, year or two. And so it's not a case of now starting the cost cutting and then having to wait for that to feed through in the future. It's actually already starting to provide some insulation. And then the last one is pricing. There's often the talk around tariffs that they're going to be passed directly on to consumers. We very much pushed back against that narrative at the start, and we continue to, because when you look at autos where we have a very stretched consumer in terms of average selling prices that have gone up post-pandemic, but also interest rates that are still historically high. So, I think that's, maybe somewhat of a non-consensus view that we don't think that they'll be able to pass that through. So from a mitigation standpoint, I think the majority of it's going to come down to how well can you cut costs, and equally how much can you manipulate your manufacturing footprint to try and offset some of those more punitive tariffs on your popular models.
100 to 200 basis point impact on margins. Before we kind of get into specific credits that we like and don't like, are there any winners and losers in your eyes, or is it still kind of too early to tell? Just thinking maybe European OEMs with a large U.S. manufacturing presence already may be able to sort of work around these tariffs in terms of production. But I know, how are you thinking about this, Jim, in terms of who's going to come out sort of more or less unscathed?
Yeah, so I think, again, it somewhat comes down to what you're comparing to. So if you're comparing to a pre-tariff world, it's the same companies that have been highlighted as being exposed that are still going to feel the brunt of the impacts, I guess. Companies that don't have any localized manufacturing in the US, Jaguar Land Rover was one that stood out. Porsche is one that stood out. Even Volvo car to some extent, where, a large chunk of their vehicles they import. But, and names like BMW, Mercedes, were arguably okay positioned given they have quite big manufacturing footprints. Again, if we kind of look back at where we are now versus April or March, it may actually be a case where it kind of flips a little bit, where, Jaguar Land Rover, for example, when we first ran our numbers on that company, we were probably looking at like a 650 plus 650 basis points of margin compression from the tariffs. For a company that has 8% margins, that's pretty catastrophic. Now, they've got this 10% tariff coming from the EU and from the UK, and 15% coming from the EU. And so, the impact's probably going to be closer to 250 basis points. So from that perspective, you have, it's a much, much smaller impact than what we would have expected. Likewise, if you think about Mercedes and BMW, there was a lot of talk around the potential for them maybe to get some concessions from the US government because they actually export a lot of vehicles from the US. So maybe there was scope for some quotas or things like that where, for every vehicle you export, you can import one tariff-free. The way that that these agreements have been reached, they're basically blanket agreements where there's no carve-outs or concessions for any individual companies. And so I think when you think about where we came from just a couple of months ago, maybe some of those companies that thought they were going to get concessions and didn't maybe have to deal with these impacts a little bit more. And some of the companies that maybe had very few mitigation strategies given the lack of localized production, actually the financial impacts are going to be a lot lower than what some of the worst case outcomes are.
All right. So let's kind of just dive into like the, we just wrapped up second quarter earnings. Obviously, I think overall, just in general, European credits have been doing, I think, a little bit better than anticipated. How would you characterize Q2 earnings? Is it sort of better than feared or worse than expected?
I would say that honestly, it's been somewhat uneventful. Obviously, it's weaker, and we've seen, weaker margins year over year and things like that. But that doesn't come as any surprise. We've been talking about these tariffs now for the best part of 6 months, and we had expectations already embedded that was going to be coming. I think one of the interesting dynamics that's come out of it is that if you kind of just put tariffs to one side for a minute and look at the underlying businesses, there actually was a bit of sequential improvement in operating performance over the second quarter. So if you look at 2Q versus 1Q, for example, we actually saw from some of the OEMs, we saw a bit of sequential improvement there. So some of that's coming from cost cutting, potentially now with some of these agreements in place, maybe consumers a little bit more willing to step out and actually make purchases. But whatever it is, I think, again, it helps to at least, now that we have the tariff impact quantified and the underlying businesses are, holding up, then, we can have a little bit more confidence that we're probably approaching levels that are sustainable, I guess, going forward, and it creates a kind of new level playing field of where we can spring back off of in terms of trying to assess where we are from a credit perspective.
Can you just kind of quantify the tariff impact a little bit more just for our listeners? And maybe you could talk about individual credits or just sort of broadly speaking, how we're seeing, margins shake out. And also, I think it's worth comparing current margins of what we're seeing now versus during peak strength of the sector in recent years.
Yeah, no, exactly. I think that, as I mentioned, we're kind of in this 100 to 200 basis point area now. And honestly, it's now looking like a mid-single digit margin is now pretty much becoming the new normal. So, you mentioned pre-pandemic, what we were doing a few years ago, 10, 12, even 14% in some instances was becoming a bit more common. But to us, that was never sustainable. And, we've been pretty consistent in our view that we never expected that these companies were going to be able to generate double-digit margins through the cycle on a consistent basis. So I think when you think about autos, the holy grail, I guess, has always been this kind of 7 to 9% operating margin is a really solid level that you can generate through the cycle. So when we think about where we are now, we're in this 5 to 7 probably at the moment. So we're probably slightly below. But as I mentioned, we are starting to see a little bit of bottoming out in terms of the negativity around the underlying business. So now that we start to see, we have the certainty around tariffs, those tariffs start to get embedded into the companies, and then we start to have an opportunity to do some mitigation, then we're actually probably coming out of this in not too bad shape where, we are definitely below where a lot of these companies are shooting for. But again, we're probably not quite as bad as what the worst case scenarios were if we'd gone into a more kind of severe or prolonged trade conflict. I think the other consideration is that, as I mentioned, this is a bit of a new normal, but one of the things that I've kind of been saying a lot is that even with these margins, we can still generate positive free cash flow. And I think that that's a really important point to kind of consider, particularly in the sense that when you think about investment grade autos, they have extremely strong balance sheets, which is something that we'll probably get to later on in the podcast. But because they have these strong balance sheets, the vast majority of their operating performance does not accrue to creditors anyway. It's all coming in as free cash flow, and it's basically getting passed straight through to shareholders and dividends and buybacks and things like that. So in a way, as a creditor, I think in some of these bigger cap structures that have the balance sheet strength, the thing you're more concerned about is, can we continue to look at the balance sheet as a pillar of strength? And I think so long as you're in a position where you can generate positive free cash flow consistently, then I think that goes a long way to ensuring that over intermediate term or medium term time horizons, that you'll be actually remain in pretty good shape from a credit perspective.
Describe, what companies are doing and being able to sort of maintain relatively stable margins. Are they planning to sort of just continue to eat the cost, or are they finding, other ways of workaround?
Yeah. So, ultimately you have two options, right? You can try and pass it through, or you can eat the cost. I kind of alluded to it earlier, but we're definitely in the camp that they're going to have to eat the vast majority of the cost. And the obvious one is the pricing element that I touched on already, which is, there's just not much scope out there right now for these OEMs to be able to push pricing. And I can put some numbers behind it. So for example, like new vehicle prices are up about 30 to 35% versus pre-pandemic levels right now. So like the cost of purchasing a new car, and the average monthly payment on a vehicle that's bought on finance, which is the vast majority of vehicles globally now, is now at about $750 up from about $550 pre-pandemic. So that's a pretty potent combination for consumers where you already have, we haven't got wage growth at the same levels as what we have seen in the past. We already have the high sticker prices of the vehicles, and we have the high financing costs to try and service that debt. So we just don't really buy into this argument that, that they're going to pass these things straight on. I think you're hearing from, anecdotally from companies saying things like, Ford saying, oh, we're gonna wait and see what our competitors do, or we're running a promotion for the next 2 or 3 months to get rid of pre-tariff inventory, things like that. to me, that's kind of semantics in a way. I think the takeaway is that they don't have the pricing power, and it's, they're acting like they're trying to do consumers a favor here, but I think it's just kind of more emblematic of the lack of pricing power, given that we saw this massive step change in terms of new vehicle prices over the last few years. So yeah, I think they're gonna have to eat that cost, and then it comes back to some of those other factors in terms of how good are you at cutting costs or doing other things to try and offset it organically.
All right, so last kind of question and topic around fundamentals, at least for now. So Jim, any concerns about ratings downgrades if a turnaround story for the sector doesn't start to build and we're sort of in this prolonged period of weak demand and sort of really kind of thinning margins?
Yeah, I mean, it's a great question, and it's one we get a lot, actually. I think there's also a little bit of nuance to consider here as well. There's definitely some structurally challenged companies out there. So like in the investment grade space, Stellantis is a great example. They had multiple upgrades since the pandemic, where things were going really well. Operating performance was going strength to strength. They have the strong balance sheet, but that's kind of been replaced now by, abysmal operating performance. And, to be completely honest, that is looking more and more like a high yield company, with every passing day. So I think one thing is that it'll be a very slow process. And one of the things that we have in the auto sector is because of the strength of the balance sheet, it does afford the rating agencies quite a lot of runway to allow things to play out before they make big decisions, particularly on downgrading companies like the crossover names down to high yield. So, I think when you look at a name like Stellantis, we definitely see downgrade risk. And that's something that, we've spoken about and will continue to monitor. I think when it comes to other investment grade names like the big three Germans, VW, BMW, Mercedes, I think a little bit less convinced that there's going to be downgrades. And I definitely don't think it's going to be at the pace where it's like a tradable catalyst. As I mentioned, the balance sheets are just very, very strong. They're very large, well capitalized. They have these very profitable financial services businesses. So, BMW, Mercedes, for example, got put on negative outlook last week or the week before. But you read through the report and you really get the sense that, this is going to be a very much a slow burn. The rating agencies are talking about over extended time periods if they can't recover operating metrics within certain parameters. But it's certainly not a case of, if we can't do it by next month, that they're going to be pulling the trigger on some of these things. I think in the high yield space, it's a different story. And we've seen, a lot more downgrades already in the last 12 months or so. Certainly there's a lot more bifurcation in that space where, balance sheets are not so strong and things like that. I think in that space, it's a little bit different, but within the investment grade space, more specifically, I think actually, we probably lean more towards there being less risk of downgrade than more.
Yeah, I guess by definition, high yield companies are, levered to their cash flows and earnings. It makes sense that they've been a bit more, kind of weaker in terms of the rating side. Let's move on, Jim. We always talk about positioning, whether it's kind of broadly speaking across, the European markets or within autos in particular. But I know you've been sort of a standout compared to the rest of the analyst team in London. But, let's kind of dive into your upgrade on European autos as a whole to an overweight from market weight or neutral back in mid-July. Did this rec change imply that you think the worst is over, or are you looking more from a relative value perspective?
Yeah, absolutely. I do enjoy talking about this part. So as I've kind of mentioned it already, but I'll just say it again, just to be crystal clear. I don't want to come across blasé as to the fundamental challenges that are facing the sector. I think, there's no question, that directionally operating metrics have deteriorated, both margins and free cash flow. And that definitely, reduces your, I guess, margin of safety when you think about like how these companies can navigate downturns in the future. But I do also think from a relative value perspective, there are actually a lot of pillars of support that you can look to right now that kind of all come together to make actually quite a compelling story. And so I'll just run through a couple of them. The first I would say is that like operating performance is good enough. I spoke about it a little bit earlier, but margins are definitely weaker, but they're good enough to still continue to generate positive free cash flow for most of these companies. And so that importantly is good enough to help protect the balance sheets. The second is that the balance sheets are very strong. And I know that that's something that's, generally been the case for the last 15 years. So you have to be a little bit careful about, just always saying balance sheets are strong, therefore it's a buy. But again, if I can just put some numbers behind it, we're in a much better starting point than we were pre-pandemic, for example. So if we aggregate up, BMW, Mercedes, and VW, who, make up about 65% of the IG index, they have an industrial net cash position now of about 67 billion, which is almost twice as strong as the 36 billion in 2019. If we look at cash on the balance sheet, as a percentage of revenues, it's sitting at about 17%, which is up from about 15% pre-pandemic. And so I think, again, from as a starting point, I think you're just coming into this from a lot stronger position than what we had, 5, 6, 7 years ago. The third thing is that duration's relatively short in the sector. It's one of the shortest duration sectors in the index. But a lot of that is because they use the bond market to finance the captive financing businesses. And you'll struggle to find many bonds longer than, say, 10 years. And it's more of like a kind of 4 to 7 years, say, the sweet spot in the auto sector. And so when you marry that up with, when I say that, operating performance is good enough, free cash flow that's, positive but not phenomenal, balance sheets that are, in very, very good shape, not only do you need, if you're going to be negative on the story, not only do you need balance sheets for credit quality to deteriorate, you actually need it to happen very quickly because of the very short duration profile. So if you think about this from if we were talking about this from an equity perspective, and looking at these equity stories, I would agree that a lot of these are structurally challenged names from that perspective. If we look out 10, 20, 30 years, will they all be here? We'll have to wait and see. But thankfully for us as credit investors, we're not necessarily concerned of whether the company is going to be here in 30 years or not. We're just worried about whether we're going to be getting paid back in our, 4 to 7 year thing. So maybe we're looking at, say, a 15-year time horizon. And so I think that there's that aspect. The fourth is that spreads are historically wide levels. So right now we're about 15 basis points wide of the index. And what's very interesting to me is that we've actually seen spreads tighten about 5 basis points to the index year to date. I think Logan mentioned it at the top of the podcast, that if you'd gone into this year and we'd said, okay, we're going to get all this tariff news, autos is going to be right in the thick of it. We're going to see margins deteriorating, free cash flow profiles declining, all these things, and spreads are actually tighter. I think, people would have probably laughed you out of the room. And so some people would look at that and say, oh, it's a sign of complacency. I would actually say that, we probably need to zoom out a little bit more, and we need to look at that massive repricing of spreads that we saw the second half of last year, where we actually de-risked the sector a lot coming into this year. And so I think that's sort of emblematic of this view that, we have actually seen a repricing that's sufficient to bake in a lot of the negativity that we're seeing from these tariffs, particularly now that we can quantify them and we can say, we can make a pretty good argument around the compensation for the risks, I guess. And the last one is more around sentiment and positioning. It's pretty horrible, I would say, generally speaking, when we talk to our clients. A lot of the investors we speak to are either structurally underweight or have just kind of given up altogether, and they're just not even allocating to the sector because, and I think it's an easy one to get on board with, right? You can say, okay, I'm either short because there's all these near-term risks around things like tariffs, around declining operating performance, things like that. Or you can say, structurally, I don't like the sector because of risks from China, all these other aspects where maybe the long-term structural story is not super, super solid. So I think from that perspective, when you marry that up also with the things I mentioned about, balance sheets, short duration, spreads that are wide, and the fact that investors, it's a pretty hated area of the market, generally speaking, I think that gives you a massive tailwind for risk reward asymmetry, where the negativity of the news that you'd need to see spreads reprice meaningfully wider from current levels is, the hurdle is very, very high, I would argue.
I think your overweight still makes a lot of sense. Plus, not to mention, you've had quite a bit of steepening of the curve. And so I think, just from sort of all-in cost of financing yourself, you mentioned autos tend to borrow shorter dated anyways. that should certainly help alleviate some of the interest burden, at least from that perspective. Jim, we've made our way around the auto space. We've talked about tariffs. We talked about the impact of margins. We talked about earnings, and then we've gone through sort of positioning. But let's kind of, come full circle, and for credit investors, talk about your picks and pans across the space. First, I guess, before we do that, I guess, can you just walk us real quickly through how you distinguish between issuers and your coverage when it comes to single name recommendations? For instance, BMW versus Mercedes. What are you looking for in the credits that you like the most?
Yeah, so I would say in the investment grade space right now, we're kind of looking at our recommendations more from a portfolio construction view, I guess. And by that, I mean, because of our more constructive view on the sector, we actually kind of favor going down in quality a little bit. And the reason for that is because when we think about the factors that I discussed above, if within that investment grade realm, some of the wider trading names actually kind of benefit from those aspects almost to the same extent as the higher quality names. So, when I talk about things like margins being good enough, well, VW margins are actually not too dissimilar from BMW and Mercedes. When I talk about the balance sheet being very strong, VW arguably has a balance sheet as strong, if not stronger than those two. When we talk about, and then when you talk about spreads, VW spreads are another kind of 40, 50 basis points wide of BMW and Mercedes as well. So I think that when we think about how we want to position and where you get your kind of best bang for buck, I guess, in the space, then I think you get better compensation from shifting down a little bit. And, just to be clear, we don't think that it's always a good idea just to reach down in quality, blindly. Stellantis is a name that trades very wide that we don't like. We have an underweight on, and we think that, fundamentally there's a lot of reasons to be very cautious on that name. Equally, if we look into high yield, we have sell recommendations on some wide trading names as well. So I think that, just to kind of clarify that aspect, but I do think in the investment grade space, the balance sheet strength is a little bit underrated, I guess, or underappreciated to some extent. So given our constructive view more broadly, I think it makes sense to be overweight VW, particularly relative to the German BMW and Mercedes.
All right. So VW, the obvious candidate. What about in high yield?
Yeah, so in high yield, I think for us, it's all about capital structure. There isn't the same balance sheet strength that we see in investment grade where you can be, where you can kind of have this more portfolio view on it, I guess, where you can kind of decide to move up or down in quality or in or out in duration, because you have very idiosyncratic stories. Names like Antolin and ZF, where, we have been talking for, probably the best part of 2 years about the unsustainability of those capital structures, where we've seen severe repricing of those bonds. They were both names that arguably looked like compelling names to own, but we managed to kind of avoid the pitfalls of being involved in some of these names that don't have the sustainable capital structure. So for us in high yield, it's less about trying to find, necessarily, whose margins are improving, which story necessarily is improving the most, but it's like who can survive for now in the high yield space. It's about being in names where you have the capital structure where, if in 12, 18 months, 2 years, we're still kind of floating along the bottom of the cycle, who's still going to be around and isn't dependent on that. So in the high yield space, that's names like Volvo Car, where operating performance is relatively weak, but has like an investment grade level balance sheet. Valeo, which has much lower leverage than its peers, and is also kind of improving. If you want to go all the way down into like single B land, we quite like Adler Pelzer, where you can get, a double digit yield on a company where, it's proven that it can handle a 9 or 10% coupon for the last 2 years. And so I think that, we've put a large amount of weight on that, and we'll probably continue to.
All right. And then obviously, you mentioned as credit investors, you're really just kind of focused more so on whether or not you're going to get paid back rather than the sort of the terminal value of the company. Who are you most concerned about within the auto space fundamentally?
Yeah. So we have underweights on BMW, Mercedes, but I would say, those are not names that we're necessarily concerned about fundamentally. Those are more portfolio construction underweights, I would say. Stellantis, as I mentioned, is a name that we really think it's going to be difficult for them over the next, 2, 3, 5 years. Like I said, they basically look like a high yield company now. Less than 1% operating margins. they've burnt through tens of billions of free cash flow over the last 18 months or so, and it's going to be a long and arduous journey for them, I think, to close the gap back to peers. They've lost a lot of market share. Their market share in the US has basically halved over the last couple of years, and that's extremely, extremely difficult to get back. And so, what you have, when you have auto companies that are as big as a Stellantis is, you don't just roll out one or two new models and expect that it's going to kind of turn the fortunes of the company around overnight. It's very much you've got product cycles in the auto space that can last anywhere from like 6 to 8 years. They have tens, if not hundreds of different models across, a large number of brands. And so, when you find yourself in these really challenging positions where you have, market share that's dwindling, you have a product portfolio that's, not resonating with consumers, and just like a subpar performance in generally, it does take a long time to rectify that, and it can be extremely costly as well. How do you win that market share back? Do you discount? Do you, or do you kind of sit on the sidelines and say, 6 or 7% market share is good enough for us? Well, that's going to be a decision they're going to need to make. But in the meantime, these margins are very, very weak. This free cash flow profile is very, very weak. It's currently rated mid triple B, but, I think almost certainly will end up getting downgraded to low triple B. And I think, I would certainly not rule out this company ending up back in high yield at some stage over maybe the next 2 or 3 years, if absent kind of something miraculous recovery, which looks very unlikely.
All right, so let's wrap up the podcast with a final topic or question, and that is, what could go wrong for the sector, or what are the risks that you're most paying attention to right now?
Yeah, so I think a lot of our thesis, I guess, is predicated on the view that, think that we can just kind of bump along the bottom of the cycle, and that, when I say operating performance is good enough, that is whether or not that's going to be good enough, I guess. So, when you think about like the margin of safety, when we came from double-digit operating margins 2 or 3 years ago, yes, we've had a whole lot of issues that we've had to deal with that have taken margins from 10% to 5%. And it's been painful for a lot of these companies, but that's now taken, even at these current levels, we still are in a position, to generate the positive free cash flow and all these things that I've spoken about. The risk, I guess, is that, going from 5% to 0%, it becomes incrementally a lot more painful for these companies. And given how capital intensive they are and things like that, the amount of operating leverage that you have embedded in these businesses, things as they get weaker start to kind of snowball very quickly in terms of the financial impact. So, if, for example, we start to see economic growth start to roll over, some of the more less constructive people around, maybe the long and variable legs of tariffs, or the long and variable legs of a central banking policy, which is rates are still very high, things like that. I think those are still meaningful risks on the downside. And so I think, if you are in the camp that, we're going to see this another significant leg lower in terms of the economic outlook, then maybe there is reasons to be cautious. But I think our base case, and I don't know if you have anything to add on this, Logan, but we think that things are probably good enough to kind of bump along. We do have a few levers coming from things like the fiscal stimulus in Europe and aspects like that, which, when we look out 1, 2, 3 years, I think you can make a decent case that while it's not going to be gangbusters in terms of like this, massive recovery, or, we're going to go through a Goldilocks period, I don't think, given where spreads trade, you necessarily need that. But maybe I'll leave the last thoughts to you on it.
No, I think those are all good points. I mean, I would also mention there's been some pretty big surprises this year when it comes to, fiscal stimulus kind of staving off an economic downturn, particularly out of Germany. But I would also mention just the fact that we've seen very strong flows into European credit. So that capital flow tends to sort of help borrowers maintain pretty healthy balance sheets. Interest rates have been coming down in Europe. Certainly paves the way for at least, a more benign economic outlook compared to some of the volatility that we're seeing in terms of U.S. policy going forward and what that's going to ultimately mean for U.S. consumption. But yeah, I think this is obviously a lot of questions still left. I mean, I think you've really framed out your argument for autos pretty concisely, and you've gone, kind of full circle here. So I think we'll wrap it up here today. Jim, thank you so much for coming back on the podcast. Hopefully we don't have to wait another year to do it again, but certainly it's been an interesting, great discussion so far. So thanks for coming on.
Yeah, thanks for having me. And I'm sure there'll be lots more things to talk about next time.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.